it has been my experience that natural resource commodities in particular are very cyclical. And because they're capital intensive, when the price around a commodity moves to the point where it would be economic, it can still take between 8 and 10 years to increase supply.
Right.
So in addition to being deep, the cycles are fairly predictable.
Rick Rule, an experienced investor, highlights the cyclical nature of natural resource commodities, spanning 8 to 10 years. He advises focusing on commodities with potential price increases, urging patience in navigating cycles. Rule discusses the misconceptions around carbon and peak oil demand by 2030, noting a $5 trillion spend on alternative energies with only a 1% reduction in fossil fuel market share. He sees opportunities in oil, gas, and coal, particularly in hydrocarbon-rich regions like Africa. Despite coal being a smaller business, Rule finds it intriguing, especially if larger investors shy away due to prevailing narratives. Shifting to uranium, once unloved, he notes its resurgence driven by the necessity of higher prices to avoid an energy crisis. In summary, Rule emphasizes understanding commodity cycles, recognizing rising price opportunities, and maintaining pragmatism amid market sentiments. With that, let's dive into his thesis.
Investors are used to different businesses, and investors, because of their own time preference, don't react well to cyclicality. When an investor is confronted with a commodity where the global production cost is higher than the sales price of the commodity, which is to say, when the industry is in effect self-liquidating, because the investor focuses on the quarter, the investor seldom realizes that either the price of that commodity rises or that commodity is unavailable to humankind. I have learned myself that focusing on questions where the answer begins with yes, in other words, the price has to go up, is better than focusing on circumstances where the question begins with if. The difference between inevitable and imminent, and having some patience with a commodity cycle, is really, I think, what's the most important reason for my own success. I like cyclicality. I like volatility. I like certainty. And I've learned, sadly, at age 70, that time preferences, neither yours nor mine, matter. You have to pay attention to reality rather than paying attention to what it is that you want. This will generate a lot of hate for both of us. Carbon is out of favor.
Wow. Yep.
The big thinkers in the world seem to believe, at least they tell us, that peak oil demand will occur in 2030 or 2032. This is daft. That's the only way I can describe it. Your attendees would be interested and perhaps horrified to know that the industry has now spent $5 trillion US over 40 years on alternative energies. And we've reduced the market share of fossil fuels from a high of 82% 40 years ago, all the way down to 81% today. $5 trillion has reduced the market share of fossil fuels by 1%. The peak demand for petroleum products, I suspect, will occur in 2060, 2065, as opposed to 2032. What that means is that if you're doing a net present value calculation, your terminal value in 2032 is the same as your starting value. In particular, African countries, since we're talking about Indaba, are endowed with very large, very rich hydrocarbon potentials, and they're being encouraged to focus on and develop energy which doesn't work. So I'm certainly attracted to the oil and gas business. I'm also attracted, although it's a smaller business, to the coal business, which is hated even more than oil and gas, which is why I like it. The idea that Rick Rule could sit stuffed away in Anacortes, Washington, and compete with the biggest investors and the biggest thinkers in the world is a non-starter. But if none of those big thinkers show up to invest, if they're so driven by their narrative that they don't pay attention to the fact that 1 billion people on Earth have no access to primary electricity, and coal provides that, I can compete with them. Laura, in a sense, what I'm saying is that even a fat, old 70-year-old like me can win the 100-meter dash if nobody faster shows up to run. And nobody faster is showing up to run the coal business. Had we had this discussion 3 years ago, I would have said that the most unloved commodity of all, in fact, the most hated commodity of all, is uranium. It hadn't performed as an investment except for poorly. And it got better than that, really. If I would talk about uranium, people would accuse me of trying to profit from Hiroshima, Nagasaki, and Fukushima. The same people who criticized me about the uranium thesis, interestingly, are asking me for stock picks. The price of uranium had to go up. It had to go up. The global fully loaded cost to produce a pound of uranium, I'm not talking about the AISC, but the total cost, including government rent, which the industry never likes to talk about, and cost of capital, which they like to talk about less, was about $60 a pound. So the industry globally was making the stuff for 60 US bucks. They were selling it for 40 US bucks. Because they were miners losing $20 a pound, they tried to make it up on volume, which did not work.
Yep.
But the price had to go up. It absolutely had to go up. The alternative was that the lights would go out. The lights were not going to go out. So that thesis has played itself out, and it will continue to play itself out.
Rick Rule declares the success of the uranium thesis, averting an energy crisis, and confidently states that the lights are not going out. Shifting gears, he humorously likens the aging U.S. to himself at 70, emphasizing the crucial link between resource demand, economic growth, and the antidote, Africa. Expanding beyond Africa, Rule eyes the geological treasure trove of Central Asia, expressing disbelief that scientifically driven investors aren't capitalizing on the opportunities in these resource-rich regions. In summary, Rule delivers positive updates on uranium, injects humor into demographic insights, and advocates for thrilling investment prospects in Africa and Central Asia. Tune in for the exciting details.
Demand for resources, and in fact, economic growth, is all around demographics. Sadly, the U.S. is beginning to look like me, 70 years of age, past its prime. And the antidote to that, really, truly, is Africa. But beyond that, there's endowment.
Yeah.
The African continent, in terms of its proclivity to generate big discoveries, both because of the inherent prospectivity of the terrain, but also because of political, social, and economic constraints that have reduced both exploration and development, means that from my own perspective, in terms of terrain, particularly to explore, given my preference, given being able to find the right people, I'm interested in Central Asia, which is to say the Tethyan Metallogenic Belt, all those places that end in Stan, and Africa. It's very difficult to understand why people who are scientifically driven rather than narrative driven wouldn't focus their risk capital in extractive industries on both Africa and Central Asia.
As we wrap up today's conversation with Rick Rule, we've delved into the intricate dynamics of natural resource commodities, unveiling the cyclical patterns and key considerations for investors. From the uranium resurgence to the pivotal role of demographics in economic growth, Rule leaves us with valuable insights. Reflecting on the potential of African and Central Asian resources, he challenges us to think scientifically in our investment approach. If you've enjoyed this exploration of financial wisdom, make sure to subscribe for more content, hit the like button, and share your perspectives in the comments section below.